Good morning, traders. Welcome to NFP Thursday. Can't remember the last time NFP was not on a Friday. I think we've had similar when we've had prior shutdowns and weather events and whatnot, but it's been a long while. Anyway, it's non-farm payrolls day today. Old data, September data. Will it matter? Won't it matter? We'll find out one way or another later on. Morning, Kay. Got your clean underwear on?
Morning, Ryan. Yeah, and a very soft cushion on my chair in case we need it. So this is NFP Thursday. Is that then officially the weekend starting tomorrow? Can we take a day off?
Oh, good idea. That sounds like it. Well, now you've called it, we might as well have it. So anyone complains, it's K-Man's fault. Why we're not
Yeah,
here
let's
tomorrow.
let's just pretend it's Friday today.
Yeah, NFP Friday on a Thursday. Love it. Right, we'll get through to the NFP stuff shortly, but there's plenty else to get through, particularly over in Japan, which I'll get to in a moment. Kicking off, though, in China, they kept their LPR unchanged, the loan prime rates unchanged, 1 year and 5 year unchanged at 3 and 3.5% respectively. So not ready to move on rates just yet, though there are reports that they are going to be preparing a new property stimulus package, whether that comes in the form of money or rate changes or whatever. We need to wait and see, but some targeted packages are coming, according to reports. Over in Japan, we've had what seems to be another BOJ member stepping across the line, flying off the fence into the hawk's nest. Koida says that bank must normalise rates to avoid future distortion. She says underlying inflation is around 2% and that Japan's prices are rising faster than underlying inflation. She needs to monitor whether food and other price rises persist and then add to influence expectations. She says the bank must continue raising the policy rate as activity and prices improve. She also had a little waffle on current moves in markets. She said it's important for FX to move in a stable manner and that the bank would buy bonds flexibly in the case of an exceptional yield jump, which we could be in the midst of at the moment. After her comments, we're now pricing a 76% chance of a hike in December, which is probably about right. We also had Chief Cabinet Secretary Kihara weighing in on the market moves, saying he's watching market moves, including the bond market, and he's watching those closely. He says recent FX moves are sharp, one-sided, and moves should reflect fundamentals. So pretty much towing the party line. Finance Minister Katayama was out as well. Not too much. We said won't comment directly on JGB yield levels. The Bank of Japan yen index has dropped to 75.23 from 75.90 yesterday. That's down from 76.20s in the latter part of last week and into Monday. So we're seeing some significant weakness in the yen broadly, and that's shown up in that index. They last intervened, or when they intervened in July 2024, this index had dropped below the 75 level. So we are getting there. And given what's happened in dollar yen, as you can see from the chart, we had a little motor into 157. We are in the window for intervention. Lots of speculation over how, why, which way, and when they might do it. We have been noting that last time in that July intervention, they did intervene after a data point that was on the Tuesday. They intervened twice in July, the 11th and 12th of July. The 11th, they just intervened. On the 12th, they did it after the CPI, US CPI data. So there is some speculation that they might go today after the NFP. Now, they could go, whether it's a good number, because obviously dollar yen would rise. They could go on a bad number because they'll have some momentum with dollar selling, or they could just go anyway. So there's no which way about they might intervene if they choose this data to intervene, Kay.
We are in the window. That's undeniable. If you look at the BOJ yen index, it's at red alert levels, right? I think the chances of intervention are of course heightened after the number. Obviously, if it's a number defying all laws of gravity, and we see that spike up to I think the next levels are somewhere in the high 158s, low 159s, could be bingo, because then that yen index is going to be below 75. The the intervention on a lower number, I am going to put a small less percentage onto that, because last time they intervened on that US CPI, even though it was a weaker US CPI and we discussed it's helping those interventions, but they intervened already the day before, so they had a kind of an excuse to say, okay, no, we need to continue to push on because of the yen. The CPI is just helping us in a way. They haven't intervened yesterday, so I'm not sure if they would really take it as an excuse to intervene. But of course, everything is possible. Yeah, I mean, there's not much else to say. It's going to be a messy one this
Yeah.
afternoon. I reckon this afternoon could be a complete mess, because wherever I look, in some currencies, gold, silver, in a yo-yo, very volatile. Yen, we have seen that on Kueda. And by the way, I still agree that there is a fair chance that they go in December, because now also they have the yen level behind them to do something.
Yeah.
Um,
And yields as well. Well
and
up.
yeah, and the yields as well. But the problem is, if you hike rates in an environment where yields are already higher, you open the risk that yields go to push even higher, because that means if they hike in December, if the government needs to fund their packages, because there's two. Apparently, Kyoto yesterday, I don't know if you saw that, but there was this discussion about whether it's going to be 17, 20, or 23, 25 trillion yen. But the thing is that there's actually two. There's the basic budget and the additional, the supplementary budget. And if Kyoto is right yesterday, we could even be looking at 37 or so trillion yen, all in all, which is going to push yields even further up, right? So if they hike in a yield environment already higher, they're going to have to step in to the bond market to help their government. But yeah, back to today. As you said already, we're in the red zone. So, but the thing is, always, are we selling dollar yen? Because if they don't intervene, and if you get even only a lukewarm number, or a number somewhere within the range of what the central bankers and everybody now accepts as being a neutral level between 0 and 30, 40, 50K, you could be looking at dollar yen at 159. If you sold it at 157.5, that's already a percent against you, right?
Yeah. Yeah. It's very dangerous. We've got to say, we've seen this situation time and time and time again, particularly leading into stressful times when intervention's on the table, and it's this sort of price action, just constant up and up and up and up and up, dips very shallow. Okay, we've had this dip. This dip came amid some of those headlines from Koida. It came amongst reports, yet another report tapping a number for this spending at 17.7 trillion. So, the numbers are a little bit all over the shop as well. So yeah, it might get a bit choppy, particularly going into the NFP as well, because anyone who's been long this is probably going to take some risk off the table, which is again bit part maybe what we've seen here. just reducing positions ahead of the NFP data. But
Mm.
otherwise, I mean, if we didn't have the intervention risk, I'd be looking to trade this one on the NFP if there were some decent numbers out. But
Yeah.
it's a tough one. It's a tough one. It's dangerous, as you say. If you hit a short, you could be offside in moments by 100, 150 pips if he wants to go on another grind. And if you go long, well, then you're running into the risk of the Bank of Japan. So from a risk management perspective, as a trader, I've got to respect that risk and decide whether I want to jump into that water or go and trade something else. And it's probably I'm going to be going looking and trading something else, depending on what we get, of course.
Yeah, I fully agree. and I trust most of our audience here are shorter term traders. This is maybe the best thing is to leave yen alone right now. For the longer term though, I mean, taking everything into account, also even if they hike in December, I don't think Bank of Japan is going to go above 1%. We are at 0.5%. So add another 25 BPs, we will be at 75 BPs. So it's still going to be a slow one. And then bearing in mind what they are doing on the fiscal side of things for the long termers, if you see 2 rounds of intervention, I suspect we are going to find buyers. But we never know where that's going to take us. I mean, if you look at where we are now, take 2 rounds of interventions, that may put us under 150. And I suspect under 150, there's going to be candidates, the more longer term people to step in again. Because yeah, yields will not rise higher. And if you look at the funding, you have to look at not like the 10-year or the 30-year or 20-year, whatever. That's for bond traders, but for FX traders, you look at the day-to-day funding, you're still going to get a bit of money to be long dollar yen from a day-to-day. So there's a different perspective to have whether we are short, medium, or long-term traders in this one.
Yeah, and just another thing to add. I don't care if I miss an intervention, if I don't trade an intervention. Okay, I know a lot of traders are going to be looking at this and the possible intervention, thinking, "Hey, this is a jackpot trade I could jump into." Again, you've got to look at it from a risk standpoint. If I'm in something and I happen to catch an intervention, great, fantastic. Then everyone who does the same is all going to make money. We're all happy. I don't care if I miss it. I don't care if I don't trade it because I'm more concerned about protecting my account. There's plenty of other trades I can do, plenty of other opportunities that will come along. So don't think you're going to be missing out on a jackpot trade because that will then potentially force you to trade something stupidly. Okay, Mark, you've put in there, why not put sell stops in at say 156.50? Yes, you can do that, but you can't see it now, but there is volatility in this pair. Okay, all it takes is one silly little rumor or whatever, and this thing can come off 50, 60, 100 pips, hit your stop, and then reverse all the way back up again. Okay, so that you've got to. It may not look like it's volatile right now, but this is on edge for a headline, a rumor, something from Bloomberg that will flip you through your stop and mug you off about it.
Yeah, and that is the risk on a negative number today.
Yeah.
I mean, okay, maybe Mark puts 156.5 as an idea, but look at 156.5 compared to where we are. 80 pips in dollar yen is nothing, right? The problem is on a negative NFP, you're probably going to go down there. Then you get, as Ryan said, you get hit, and then the market turns around and says like, yeah, well, I don't want to be long yen, and they buy it, and you're back at 157.25 before you know it. I mean, if you think about interventions as such, okay, I mean, the only thing you could do if you want to play it that way, but it's really not advice because I won't do it, is put a stop at 155 because then you're already 250 pips away, and that is going to be more than the amplitude of an NFP. The thing is, if they intervene, where's your stop going to be done? Because I mean, there could be a gap of 200 points, and your stop is done at 154 and a quarter, and that's nearly the low of the intervention. I mean, this it's just very, very, very dangerous to do it in yen. And on the flip side, if it's a bad number and you buy it at 156, take your profit really, really, really fast, because the next leg higher may be bingo, right? On intervention. So it's a tough one. I'm really not looking to trade it straight away. The longer term trader in me says that if I see a really big one, brings it down two numbers with the 1.4 in front instead of 1.5, I'm going to be looking at doing something on the other side, because I think the global picture hasn't changed.
Yeah, and but then again, if they do a July thing, they hit it today, then they hit it tomorrow, and
Yeah,
and then
but
your
that's what
140
I'm.
figure is 130 figure.
Yeah. Oh, yeah, but that's what I'm saying. I mean, well, yeah. I mean, is a bad NFP could actually be yeah, as bad as the CPI that we had in 2024. But anyway, I mean, if I'm just looking at, if they do two rounds of intervention, you do 500 pips each. That's going to put you under 150, right? So there, I think we may find some support. But it's, again, it's something, no investment advice by any means, for sure.
Yeah, yeah. So anyway, we'll
Yeah.
keep you informed. Whatever happens, if something happens, we'll be on top of it. And yeah, if we feel like it's worth having a trade, you'll see it in our chat room, in our trade room. But yeah, it'll be a reaction thing. It's certainly not a plan it in advance type thing. So no, I certainly won't be dropping any orders in my book hither and thither. Right, let's crack on with the news, Mike. We'll get to the NFP in a bit. Where am I? I've lost my place now. Right. Speaking of interventions, there has been a story out that Asia central banks have amassed nearly $8 trillion in their foreign exchange reserves, part of a build-up to protect against pressure against their currencies. Because it's not just Japan that's facing this pressure. We've had India intervening, South Korea on the intervention list as well. So there's a lot of Asia countries who are under a bit of pressure with their currencies, and they've been building up their FX reserves with which to use to do battle with it. China still holds the most at $141 billion. Japan is second with $116 billion. So they have got a hefty crate of ammo to do with intervention. Not that they have needed huge amounts, shall we say, to give it a knock. We're not talking, tens of billions or anything like that. So, they don't need an awful lot. But they've got the reserves to do it. Don't forget that. They've got bigger pockets than you, I, or everyone else. Don't know if you've got any comment on that about the reserves, Kay, because it is an important.
Are you sure
thing.
you're not? Are you sure you're not a zero missing there? Is that not 1 point something trillion?
What in the?
Yeah, I mean, China and Japan. If you take, well, okay, maybe it's just what they have in pure FX reserves, because Japan, last time they intervened, they sold treasuries to get more dollars, because
Yeah, they've got.
they intervened for over $50 billion last rounds.
Yeah, no, you're right. It does look a little bit low. I don't know.
No.
I can
It
check
must
that
be
out.
1.2 and 1 point something trillion, I think.
Yeah, quite possible. Quite possible. Yeah, I'll have to have a look into that. I know they've got that sort of number in bond holdings. Yeah, well, yeah, I have to check that
But
out. Yeah,
that's what Japan should be using, again, in parts, because the intervention to sell dollars is markedly different than the intervention to buy dollars, right? If they want to buy dollars, they just print yen and buy dollars with it. So
yeah,
the selling side is eating in the reserves, really.
yeah. Okay, doke. Right, well, let's move away from those guys over to the RBA. The RBA's Hunter saying that monthly inflation data can be volatile and they will not jump at 1 month of data. It says if we see growth running above trend for a sustainable period, that would generate inflationary pressures, which if they get that, might even push them towards the hike side rather than sitting on their hands, let alone the cut side. PM Starmer, UK PM Starmer might have confirmed that tax thresholds will be shifted at the budget because he declined to comment on tax thresholds when asked yesterday. And usually when politicians do that, that's pretty much a confirmation, but we'll have to see. In the meantime, ahead of the budget, consumer expectations for the economy in the UK over the next 3 months have fallen to plunged to -44 from -35 in the last survey, according to the BRC. So things are not looking good, although they did say spending was up at the highest since 2024 in the run up to Christmas and whatnot. But their thoughts on what's going on in the economy is looking very bleak. It might get even bleakier after the budget. We'll wait and see. We got a bit of data out from the good old US of A yesterday. Bits and pieces still dropping as they see fit. Trade balance coming in slightly better, 59.6 billion, or the trade deficit, should I say, slightly better, 59.6 billion. As you can see there, we also had the Atlanta Fed GDP now flash number, or another flash number for Q4, coming in at 4.2% from 4% previously. We had a 20-year sale yesterday in the US as well, which was a little bit wobbly, shall we say. Not enough to have it falling off the bike, but it had a little bit of a wobble anyway. The bid to cover was down at 2.41 from 2.73. Directs came in at 29.1 versus 26.3, and the indirects, which is foreign investors and the like, dropping to 59.5%. from 63.6%, so soft on that aspect. White House Economic Advisor Hassett, talking about data, says future revisions are likely to show stronger productivity. He says he's seeing unprecedented boom in productivity, and 85% of the US economy is getting a massive productivity shift. Saying that Q3 2025 was the best ever for earnings surprises. Very bullish sounding Hassett coming out yesterday. We had the FOMC minutes, which really again shows the split in the camp at the moment. Most participants were judged that further downward adjustments to the rate of federal funds would likely be appropriate, although several of those indicated that they did not necessarily view another 25 pip cut as likely to be appropriate at the December meeting. There were several participants that assessed that a further lowering of the target range for the Fed funds rate could well be appropriate in December if the economy evolved about as they expected over the current intermeeting period, though many participants suggested that under their economic outlooks, it would likely be appropriate to keep rates unchanged for the rest of the year. There we go about that. No one any the wiser. Last night, unless you've been living under a rock, Nvidia kept everyone happy with their earnings. Indices took a bit of time, but they rallied well after, pretty much peaking in Asia. That rally was helped too by the Wall Street Journal reporting the US Commerce Department is going to approve a deal to sell AI chips to Saudi Arabia and the Middle East. There is a bit of advisory, though, that they can't go on to China from that. So stock looking very positive this morning, or were looking very positive this morning. Still are. They're off a little bit, though. Over at Russia stuff, a US official sees Russia and Ukraine peace framework coming by the end of November. A senior White House official says they expect a framework for ending the conflict to be agreed by all parties by the end of this month and possibly as soon as this week. Ukraine popped up to say it had no role in preparing the proposals, but a US Army secretary has popped over to Kiev for high-level talks to restart peace talks. Now, the basis of all this story is reported again by sources that Trump has been looking at halting the war, but Ukraine giving up large chunks of territory that Russia has already taken, or not getting that back, which obviously has been one of the no-nos from Ukraine. So the plan in itself looks similar to what Trump touted way back when. So it's probably not going to fly, but it looks like we are having another concerted push to get something done. So keep an eye on those headlines. Right, data. Been a load of updates just to run you through. So these will all pop up in the calendar as and when. The August wholesale trade balance will be coming tomorrow. September retail sales will be coming 25th of November, as will the August inventories report. The September durable goods data is coming the 26th of November. More importantly, onto the jobs. The BLS has updated their stuff. There will be no September jolts coming, and the October jolts report has been rescheduled for December the 9th. So some missing data there. We won't get that. There's no October NFP. So that's the NFP number, but we will get the October establishment survey. That's the household survey, and that will come with the November jobs report. That's been scheduled for December the 16th. Now, that's important because it will now come after the 10th of December FOMC. So the Fed will not get that October data before, or November data before the FOMC like they would normally. They would get it on the 5th. So they are getting it on the 16th. Now, that's caused a bit of a undovish repricing of rate expectations, because we've gone from the 50-50 we were turning around over the last few days. We now see a 76% chance of a hold rather than 50-50. So that's what that data shift has done to pricing. Hence why the dollar's been a bit bid as well. So just moving dates on a calendar has caused a bit of a reprice in markets. But anyway, that's the data rundown. You can see most of that news in our chat room. I've put all the reports and links and whatnots in there, so we know what's coming now. Right, so we are getting the September NFP today, so that's what we need to concentrate on. Now, expectations, they've jiggled around the 50k mark. They were 50k when we were originally due to get that, and the survey range was, I think, 30 to 80k, something like that. So this calendar has it at 53k. Let me have a look. We got 51k on another calendar, on the Bloomberg calendar. Now, this is where the fun happens. Okay, we might be seeing some of the Doge numbers dropping into this. This is what happened back in April, I think it was March, April, when Mr. Musk got busy with the hatchet and chopped a load of jobs. I think we were up to about 230, 300,000 or something like that. A lot of those jobs were contracted until September. So if they've rolled off, then we could start to see some of those government numbers coming in to there, which I expected down, or were last at 16,000. They are expected in, if we got anything there. No, can't see any expectations for today. So we could see those appearing in this number here as a negative. Now, I say they might drop in. I don't know whether these contracts were all set for the same day across September, whether they came during the reference period. So anyway, it's a big unknown. It's a known unknown, but it could be a potential big one. The other thing is, if we're not seeing those numbers in September, we probably would have seen them in October. Well, we're not getting the October data. So that's going to make that December reading after the Fed another big, huge mess. But we can worry about that in December. So as far as this jobs data is concerned, okay, I am only going to concentrate on the private payrolls number. If I can find it, where is it? Have they even got it on here? There we go. That number there, okay? Because the NFP number is the net number of private payrolls, manufacturing payrolls, and government payrolls. Okay, so if we see a negative government number, as I say, it's a known unknown. Okay, we all knew it was coming, so it's not going to be a shock to the market. So if we see a minus 300,000 in government jobs, but this number comes in up 200,000, for example, we're going to see a net minus 100,000 headline. But that private payrolls will be the important number. That's the one the market will look at. It will say, we know the government stuff was happening, but normal economy has put on 200,000 jobs. That's a positive because we've only seen double-digit numbers recently. So that's the way I'm going to be looking at this number. So it could, if I do want to trade this, I'm going to be trading it on that private number, depending on how it affects the non-farm payrolls. If that comes in 200 and government 0, then NFP is going to come in up 200 or something. So it's going to be positive anyway. But that's where things could get funky, watching between the net number and the private payrolls number. After that, look at the unemployment rate, participation rate, and all that stuff, wages as well. So this is where it could be a very funky number. Kay, what are your thoughts about this one?
I'm only going to look at the Philly Fed capex today. I mean, the rest I don't really care. Oh man. No, in all seriousness, yeah, I think it's the right approach. That is going to be the most important number. We could see a very distorted print on the unemployment data, or the unemployment rate. But again, even that unemployment rate, it's, as I've been banging on about, it's going to be numbers that money managers can put in their models and probably going to have an impact on bonds. So, however the numbers come out, what I'm going to really keep a very close eye on is the 2s and the 10s. And I would argue for immediate impact on the Fed, maybe even the 2s being more important than the 10s today. But obviously, I mean, the 10s are always going to be an expectation yield, so they're probably going to be on the move anyway. But I'm expecting a bit of a move in the bond market today, and that is in turn going to drag the dollar around. And as we've seen, and Mike was asking about this, why did we see that move in the euro dollar? I mean, there's two reasons. There's one is market. Yeah, I mean, adjusting their positions. Dollar yen extremely big, dollar Swiss extremely big. The rest of the dollar, sterling also relatively under the cushion, and the euro dollar just was a result of all of that, and of that repricing of the expectations for the DEC FOMC, because the Fed can now hide if this number is a bit of a distorted number. The Fed can hide behind the fact that, oh yeah, but this is not the full set of data that we wanted to see, and go on hold in December. So that is why we are seeing this dollar doing better. Yeah, the private numbers, and then yeah, maybe the unemployment rate if it comes out a bit further away. The wage data, I don't even know whether we need to look at them right now. I don't think so personally. I don't think. Let's look at just numbers.
Yeah.
And the wages.
Unless it's an outlier number, like it jumps to
well,
4.1% or drops to 3%, we'll worry about it. But anywhere sort of 2 pips either side of 3.7, don't worry about it. Move on.
No, this is not anyway going to be on my watch today.
No.
Yeah, and then we will see what happens, and I'm going to be reacting instead of acting. Not planning on really having anything. I'm flat in dollars completely. I've only got a few crosses on, and I'm happy the way I'm in it right now.
Yeah. And Mike, you're right. It is September data, so it's old hat, but this is the first data. It's the NFP, and it's the first data we're getting since the shutdown. If anything, it's going to potentially justify what the Fed did in October, at their meeting in October, and it's going to potentially affect rate expectations moving forward to December, because now we're not getting any other jobs data or any other NFP data before the Fed. The market's going to have to make an adjustment on this stuff. Now it's on the calendar. This initial jobless claims data. It's supposed to be for the week ending November 12th, I think. But as we only got October 18th, this data might just be playing catch up for a couple of weeks until we get there. So I don't know if that data is going to be for the latest data or the week on from that data we got on Monday, was it? I think. That it dropped.
Monday, Tuesday. Monday, Tuesday. Yeah.
So just keep an eye on that one. If we see it, if it's a wobbler, then I'll take a closer look and see what date it's for. Right. Anyway, so everyone should be up to speed on the data. Yeah, we get a bit of Canada data. No one's going to give an absolute monkeys for that at all later on. So yeah, don't worry about it. It's all going to be about the NFP today. So be ready and make sure you are covered and protected. It could be a very volatile one. Right, we did have a quick look at dollar yen. That's on the march, on the march, on the march. What are the next levels coming up? I mentioned this last time we looked at it. We got some levels just coming into 158, 60, 70s, just ahead of that 160 level, and where they last intervened up at this level up here around the 161.80s. That intervention plus what happened in the US, because it was the peak for interest rates as well. After that CPI data came in a little softer, and look what happened after that. Now, I don't think we're in the same form here as we are now as we were back then. We don't know if we're on the cusp of a change in data, a change in the economy in the US. As far as it looks now, things are still ticking along okay. Big question mark over the jobs picture, but given what all the Fed heads and surveys have been saying, we're still in a no hire, no fire situation rather than a no hire, lots of fire situation. But we could also be close to start seeing some joblessness coming in, which will make things more dovish. But this was a big moment because, as I say, rates topped out around this time after the inflation blip, and inflation had already topped out and was coming lower. So this was a change in the Fed, a shift to more dovish and a rate cut cycle, albeit it was fairly slow. So we're not in that situation here, I don't think, Kay. We're not in an economic situation where there's a big turn potentially coming.
No, absolutely not, because in the meantime, the Fed has already cut a number of times. Also, during that period in 2024, we had a few wobbles on the jobs as well. So there was a bit of a triple headwind for the yen. Not only the speed of the move, the interventions, the lower CPI, the Fed repricing, but also a wobble on in the jobs market over the summer, I remember. So yeah, no, it had a lot for it to produce such a huge move. I don't think we are there right now. We are close to those levels, obviously, but I don't think we are in the same situation. Unless we get like a really, really, really bad jobs report here today, and then the outlook for the Fed to cut in December will change again, and then we could see a pretty steep drop. But yeah, we will see after the number, obviously.
Yeah, absolutely. So apart from that, I don't think we're going to see too much moves between now and then in so many other pairs. Who was me asking about Aussie Kiwi? I'm keeping a beady eye on this one. It has been on a bit of a rip higher, well, slowish rip higher. We've hit another level, just this prior action level that we saw up here. So it's topped out there, hasn't dipped too far. So may yet get a move up to this level that I'm keeping an eye on for a potential short. If we hit that and hold it, then I might have a little nibble. Can be fairly tight. Keep stop just above those highs, something like that. But again, it's had a significant bounce off this 38.2. Had a little poke, had another little poke, but didn't take long to get back above it. So in the context of the wider trend, it's still looking very, very strong. And this is just in minor pullback territory. But yeah, we'll see what happens with that one. Are you doing anything in that one, Dimmy? Let us know in the chat there. What else again? Yeah, as I say, I'm just in watch mode at the moment. Dollar CAD, that's not doing an awful lot. We're back above that 2030 area, back above the 140. We had a little dip to the line on Tuesday, a little poke under, but give or take, it held on my line there. We're back up, but we're just peaking out around this 140.60 area, just running out of puff, it seems, at the moment. Again, this one could be one of the pairs I look at to trade the dollar over the NFP, depending on what happens, because it has got some fairly clean levels in play. And if we get again, it's still maintaining the uptrend that we've seen from the 135s. So it's still well entrenched, that trend, and not looking to change anytime soon, because there's the 38.2 down there at 139, which is good level as well. Right, I'm going to pass it over to you, mate, because we've been waffling on for so long anyway.
Yeah.
Right.
Just going to look at a few other ones. Yeah, I'll look at the euro dollar as well. Aussie. All right. And here I must confess that I thought for quite a while that Aussie would be one of the better ones, but it's been slow and difficult to bounce really. So today we'll have to look at what's happening here and assume, just in the assumption that we have a better jobs report. There's a pretty big support zone looming under where we are, and that's going to be somewhere. Okay, the 64, the figure as well is a 38.2 of that. Bigger move, but the 64, 15, 64 and a quarter. If we would see a decent surprise on the NFP, it would be possible to go and have a visit there. So to me, that's going to be an important zone to watch to the downside if ever the NFP does better. Top side, we know where it is. It's right here, 65, 20, 30. And that's if it goes back above there, that will likely mean that we have a very bad NFP report and that the market needs to reprice once more its view on what the Fed may do in December. We've seen inflation like remaining kind of in a standstill right now. So it's really the jobs who are, or and I'll just repeat what I said. I think the money managers, they are waiting for this data to stick into their models and to and to do stuff. So I guess we are going to see the yields move this afternoon. So will the dollar. So will stuff like this. Don't forget it's a risk currency as well. So a really good report may see the Aussie dollar come down and test this level, but then maybe the Aussie crosses do a bit better. But in any case, this is a pretty decent support zone, I reckon, on the Aussie dollar. Another one, obviously, euro dollar. As I said, euro dollar is still, to me, somewhere the victim of the repricing in the dollar. The rest of the dollar pairs doing well. And maybe the market being a bit long as well, adjusting positions in the euro going in there. And I would say it could be one that is one of the currencies of pairs of choice if the report would really be bad. If it would be a stinker, it's going to weigh on risk. It's going to weigh on the dollar. It's going to weigh on the yields. And we also know that euro crosses, they tend to be bid versus commodity currencies, etc., on very bad economic data. So this could be a double push higher for the euro dollar. So again, I'm trying to look at which currencies is potentially doing better than other currencies versus a dollar in both cases of the report coming out. Okay. What's happening here? Obviously, if we break through 115, we probably will have a look at this 114, maybe 114 and a half, and then here where it's going to be very important around 114 if it's really a very good one. But in the assumption it's a bad one, this one could actually relatively easily, I would say, jump back over this 115.60, etc., and go have a look back at this 116, and it's around 116.10-ish also. I'd I'd still argue that the main level here, this is going to be really the door 116.55, stretch it to 70 for much higher. So we don't know if this number this afternoon is going to have enough power to see such a move. But the euro is one of those currencies where I'd say, like, if it's a really bad report, it could be one of those that do a lot better. Cable is a bit of a if you look at euro sterling, it's hopping up and down, and yeah, sterling is still under the cush. Yes, the market is still worried about the budget coming next week, in a week's time, by the way. But we are, if you look at this and you look left, we are just above a relatively important traffic zone, in my opinion. We've seen, so this 130.45 is the low of, roughly around the low of the day, give and take a few algo pips. It's been a high here, been a bit of a traffic in this area, traffic here, high here, traffic down to where the 50% lies of this move, which is 129.45-ish. Okay, you could stretch it a bit lower as well here. But basically, the next big figure here in the cable, if we would get a good report out of the US, is going to be important in my opinion, because it not only psychologically we would trade below 130, but it's been a decision area in the past. Okay, it's actually this high here is also not too far away from there. So I would say the next big figure below here is going to be very, very important for the cable. That's what I think. Top side, I mean, we're still going to see the same numbers pop up, maybe the 130, 140, and then the 130, 185, all the way up to 132, 132.10. If that breaks, then potentially we're going to see higher but for that to break in stuff like the cable, it's going to have to be a really, really bad one. I would still view euro maybe as being the better one if the report is a real bad one. Okay. I've seen you, Ali. To me, euro Swiss still hasn't changed. It's here 93.15-ish. That's where we need to have a look at, and then you take as a confirmation those prior highs here 93 and a quarter. I'll be a happy profit taker if it comes there, but I mean there's no reason for to be short right now in my opinion. And then traditionally, let's look at the metals. Um, Up and down bounces in gold, but we need to acknowledge that could have to do with the dollar, of course, of what we have seen over the past sessions in all currencies. The bounces have been lower, okay? And we try a little bit lower here. So there's a bit of a new crossroad here around 40.20, and then obviously the 4,000 will be a level that the market will be watching, okay? Below there, it is possible that we get back into that 39 and a quarter, 38.85 zone if we drop down below there, okay, which would be the case potentially on a very good number, because that's risk positive, dollar positive, yield positive. So that would push gold lower. Get a real bad one, gold is the other one, apart from besides the euro, which I would be looking at, because a really bad one is probably going to put this 41.10.25, potentially 41 and a half under pressure again in gold. Silver, I prefer not to do too much with it right now, because if you look at only the last week's moves, they are a bit fast for my liking. Just 52 and a half, 50, and then Watch this zone here below, which held last time right around ish that trend line here, 49.30s, 49.20s. If we get a confirmation below, I think we could see 47.5 again. But for the time being, I'm not sure what to do with silver, because and for that I'm sitting on my hands. Derej, sterling yen is a real difficult one for me, because I'm not a bull on on any of them, so it's a bit of a naughty one. I'd say we're above these levels here, but it's the yen, right, who's doing everything. I was looking at the euro yen as well this morning, because I went out of my position, but that thing is also still a bit. It's just a factor of the yen, right? For as long as we're above like 205, it can continue to go higher. Maybe here 204 the figure. If it would come down, perhaps this one could come down a little bit on a very bad number, weighing on risk. Okay, because sterling and yen are both still somewhere linked to risk. Maybe this can come back down to 204, and then you see what's happening there. But again, if it's a risk positive number, that euro yen is quite a monster, actually. Even with the euro dollar lower, that thing is still running above its long-term trend line, which comes in at around 17, just below 180. So for as long as we are above 179.80, 180, I'm not going to even start looking at doing something to the other side, perhaps, because it's, again, for as long as we don't have interventions, it's not really worth, for me at least, to look at building a long yen position. Yeah, that EuroCAD Addy, just still in that in that channel. We have to be a little bit careful for risk this afternoon, I'd say. If we get a real risk positive picture, this channel may be in danger in the EuroCAD. Coming in at around 160.5, take a confirmation level around 160, 135 maybe. It may be in danger, the channel, if we get a real very positive risk report this afternoon. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Oh, busy old show today, eh? And yeah, it's going to be a busy afternoon, I think. So I can only repeat what we said earlier. Stay safe, traders. Don't be looking to hit the home runs when you're playing with a bunch of crocodiles at the moment. So take care. We always come back and trade whatever happens tomorrow. There'll be plenty of other opportunities. All that being said, we'll go over the mess tomorrow on the Flow Show. So it might be another busy one, but it'll be Friday, so no one will care. So enjoy the rest of your day. Thank you, Kay, and we'll see you all tomorrow.